Welcome to Bill the Lender podcast, devoted to educating you on a variety of financial subjects with an emphasis on real estate and real estate finance. Please click the button to subscribe to my channel so you don't miss an episode. Then like and share your favorite episodes. Hello, everyone, and welcome to another week of Bill the Lender podcast. I'm your host, Bill the Lender. And today we're going to talk a little bit about buydowns and ARMs and helping consumers understand why these products are coming back into the market with the shift in interest rates. Now, a lot of things are determined by what direction the market is going. And in our last episode, we talked a little bit about the difference between a buyer's market and a seller's market, and where I think we're heading, which is to more of a balanced market, where neither the buyer or the seller has any distinct advantage over the other side. Now, a quick review, a buyer's market, there are more product, there's more houses for sale than there is demand from the buy side. A seller's market, there's more buyers and then available units on the market, so sellers have a distinct advantage. In this case, with the rise in interest rates, people are really looking to control their payment. And I think that there is a strategic bet for you as you're a consumer trying to enter into the market. We need to be talking about ARMs. We need to be talking about buydowns because these are things that were popular. But if you haven't been in the market or your view of the market is of a specific generation, you're going to have certain stigmas about these types of products. And the first thing that I'm going to tell you is that there is nothing inherently evil about a mortgage product. But after 2008, in 2009, the crash, there's a certain millennials and Gen Ys, there's a certain generation of buyers that really watched their parents and friends that they knew get into a lot of trouble with these types of products because there wasn't the amount of fiscal education or fiduciary responsibility in the market at that time to help consumers adequately understand how to use this specific tool. And any mortgage product is in and of itself a tool. And if you understand how to use a tool and you bring the right tool to the job, you can be more efficient and you can get the job done faster, easier, and with less effort, right? So in this case, we're really trying to control payments and manage our costs and jumping into a market that it, for all intents and purposes, and some, may argue that there's going to be some softness to the market. And we do see that coming. We do see some softness in the market now. We talked about that a little bit, where we're seeing prices fall because people are taking that extra cream off the top where they were pricing in an additional 4 to 10% over where the property should appropriately be market priced. When we're seeing that sort of come off the top. And if interest rates continue to rise and we don't see relief, we may still see a little softening in the market. But because there is still short supply, and we talk about this on the show all the time, and high demand for housing, our position on this show is that, housing prices are going to continue to stay strong. And if they continue to stay strong, then affordability now becomes the issue. And affordability is primarily controlled. The biggest impact that you can have on your payment is the rate, because that amount that you finance over time, those payments, is controlled primarily by your interest rate. So if you can have a way to lower that rate, even though the market rate may be higher, and have a significant impact to your payment, which will allow you to buy more home, right? And allow you to manage your cash flow for a period of time. So we talk about this as a tool now, okay? And we're thinking of it of the mindset of, okay, if there's not a significant softening in the market, and I'm still trying to find a place that I own for my family, that is my permanent place, and I need to control my cash flow, then we can now start to introduce the concept of an adjustable rate mortgage, which means that that interest rate is going to be lower for a period of time. And that period of time is going to be a 3-year, a 5-year, a 7-year, and a 10-year period of time. Now, when we talk to our clients and consult with our clients on the appropriate length of time that they should select for their mortgage arm, that is going to be, factored in a couple of different ways. First of all, you have to take into consideration how long you're going to be in the property. If there are any major life changes, so this isn't your forever home, this is your starter home, are you going to be expanding your family? Are you going to outgrow this property? So again, the timeline and horizon that you're going to live in the property, you're going to either keep the property or you're going to sell the property. Is this going to be, if not a forever home, are you going to keep it as an investment? So you're going to live there for a period of time like a housing hacker, and then you're going to move on, but you're going to keep this property as an investment property. The length of time always factors in to the conversation of how long you may select your arm, that fixed period for, whether that's going to be a 3-year, a 5-year, a 7-year, a 10-year horizon, may depend upon how long you keep the property. Are there other investment concerns? Are there other life changes? And we could go through a list. Maybe, unfortunately things happen. You acquire a property with a partner. You don't stay together, or that partnership dissolves. Maybe it's a business relationship and that property needs to be liquidated. That can also factor in to what we're talking about here. But in general, if you have a 3-year horizon, you should always pad it by a couple of years. So let's say you're going to move to Colorado. You have a limited engagement. You're contracting or you're consulting for a company for a 2 to 3 year term, and you're going to purchase a property here in Colorado. In our mortgage consultation, we would tell you that you would be safer to look at a 5-year arm, because the reality is, in talking about an arm, is again, that arm is fixed for a period of time. After that period of time, the arm can then be a variable rate mortgage. Okay. We're going to talk about what that means. But the most important piece in terms of recognizing this and taking some of the fear away from this mortgage product is that, most people think when they hear ARM, they hear adjustable rate mortgage, and that's all they hear. They think that if they get an ARM that from day one, that the interest rate is going to adjust the whole time that they have that mortgage, and it's just not true. There's a fixed period, and as long as you can manage your life inside of that fixed period, then this is a safe product to use for a specific reason. And like we talked about, it's affordability, it's cash flow. So if you can manage your cash flow inside that period of time, that 3, 5, 7, 10, then you'll be fine. All right. If you can weather the storm even after the arm adjusts and you have that flexibility in your cash flow and things are going well. The reason we usually tell folks, if you have a 3-year horizon, give yourself another 2 years as a pad, is because you never know in the future what you're going to be delivering if you have to sell the property, what market you're going to deliver that property into. We don't have a crystal ball to always know and always say that, hey, the market is always going to continue to appreciate. That's where we got into trouble in 2007 and 2008. We came up with all these exotic mortgage products. We didn't educate the consumer populace, and the assumption was that property values would always continue to rise. But there will be a time and place where the market does get soft and the market does retract. And if you don't have to sell your property into that market and take less than what you should, then having an extra 2-year pad makes a lot of sense, because then you have control over when you decide to deliver that property to market. Okay? So it gives you that flexibility in term. It gives you a little bit more control. And it allows for some peace of mind when you're stepping into something that's not a fixed rate mortgage. Because, one of the things that invariably happens is when we talk to our friends and family, because we're so excited about buying our first house, for the first time. And now that we're in an upward interest rate moving market where most of the consumers that are listening to this show have never actually seen or experienced themselves, somebody introduces the concept of an ARM or a buy down, and they're like, whoa, 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 whoa. Everybody tells you not to do it, right? And you're getting all this advice that says, no, pump the brakes. You can't do it. That's exotic. You're going to get into trouble. And this show is designed to educate you on why. I mean, and everybody has a level of comfort, right? So you have to get to the level of comfort that, invest where you feel comfortable. Right? Understand and use the products that make sense for you. But today we're here to give you a little bit more information on why you might choose a product like that. Because if prices don't fall and you still need housing, but you have a limited budget, then we've got to take a whack at trying to fit today's price into your budget, into today's budget, right? So we're gonna look at an ARM, and typically ARMs are priced significantly lower than the market rate. So if and before I get into rates, understand that everybody's situation is different. It depends on credit, depends on qualifying standards and these types of things. And we can't go specifically into specific rates. However, let's just say the market rate today is at 6%. Well, a 3-year ARM might be priced in the 4s. Okay, and for every I just ran some numbers before the show for illustration purposes, but typically on a $417,000 purchase price, if we're going to lower that payment from 6% to 5%, that's going to be roughly a $264 difference in payment. And if we go from 5% to 4%, that's going to be another $240 difference in payment. That's significant. So from 4% to 6%, we're talking about almost a $500 difference in cash flow. And if you could do that for a period of time, and understanding that your mortgage professional will help you find an exit strategy that works for you inside of the fixed rate time frame, would you consider doing that? I don't know. But it's good to understand what it is. Because if I could save you $500 today and get you the house that you want so that you're not paying somebody else's mortgage, and you're putting that money in your pocket and saving yourself $500 a month, you might consider it, right? Now, the other thing that we're also seeing is sort of an old school technique, buy downs. Buy downs is a fancy way of giving you some temporary relief, or permanent. There's a permanent buy down too. There's a 3-2-1, there's a 2-1 buy down, there's a permanent buy down. Now let's talk about what that means. Okay. A buy down, a permanent buy down, let's start because that's the easiest one. You take your 30-year fixed mortgage and you're paying some upfront fees in origination or discount to buy down the rate, but it's over the life of the loan. So if you think of an interest rate has a lower fee option, and you can pay more upfront to get a lower rate option. Okay. If you opt to pay more in fees, you can buy down that rate. Let's say we use the example of 6%. If I wanted to pay 1% roughly, and again, all of this is based upon credit scores and these types of things. So these numbers are not exact. You're going to need to reach out to me to price out your individual situation. But illustration purposes to give you sort of an idea of how this works. 6%, you want to pay 1% in origination. You could buy it down to 5.5%. Okay. And typically speaking, every 1/8 of a percent is right around $35 to $40 in payment. So if you buy it down to a half, you're going to save yourself $80 a month in your payment, which is great. So, but that payment on a 30-year fixed, by paying those fees up front, you're never going to have a variable rate. You're just going to be paying $80 less a month over the life of the loan. Well, you can theoretically buy down the rate as low as you want. And most people don't understand this. If, it becomes cost prohibitive at a certain point, but you could theoretically, let's say, buy it down to 4.99 or 4.5%. And that's over the life of the loan. And again, these days, because the market is turning and sellers don't necessarily want to make a price reduction, a lot of agents, listing agents, savvy agents, agents that have been around the market for a period of time, are offering these buy nows as an incentive against their other competition on the marketplace, because we are seeing those price reductions. But we still are in a place in the market where you can reasonably adjust the value of the home, and the seller gives a credit to you as the buyer because the market's shifting and we're moving a little bit more. And that's evidence of a buyer's market where the seller's giving you a credit now instead of you paying over asking. But in this case, illustration, the market's changing. Here's how it works practically and how we're seeing it today. The sellers now, instead of reducing their purchase price, they're going to give that money back to you as the buyer to buy down your rate permanently, or maybe do a structured buy down, which is these 2-1s and these 3-2-1s. Now, a 2-1 buy down means that, let's say, again, the market is at 6. Your first year, your interest rate to determine your payment would actually be at 4%. And that's what your principal and interest payment would be determined off of. Okay. The next year, the rate would go up to 5. And then in year 3, you would be back at market rate at 6. Now, the seller is paying the difference in those principal payments to go down to 4, to go down to 5. And they're either paying that up front or they're escrowing that on your behalf to pay it for you to make their property more affordable to you. Now, again, a specific advantage to managing the cash flow. In the 3-2-1 buy down scenario, your payment would go all the way down to 3, year 1. Year 2 would go to 4. Year 3 would go to 5. And year 4, it would be at market rate at 6. The advantage being that in year 1, when you're making that stretch to afford the house that you're trying to buy, you're getting the advantage of the cheaper payment. And over time, as the payment graduates, you're getting used to making those market rate payments. It's taking you longer to get there, another 2 years inside of that scenario. But you're, hopefully things are going well and you're doing well on the job. You're getting, cost of living increases. You're getting raises and these types of things because you're performing well. And inside of that, there's always the opportunity to refinance into something that is a lower rate. And that's this strategy that we're talking about uniquely now because of the fact that we may be heading into a recession. And we haven't talked about this too much on the show. I've mentioned it in passing, but if you look historically at interest rates, what tends to happen when you're in a recession, and by the way, Forbes just launched their article last week, and they've been hammering this throughout last week that we are officially, from the standpoint of how it's clinically, technically defined, in a recession. You have 2 quarters back to back with negative GDP growth. Now, there is an economic bureau that is the official, designator of a recession, and they haven't said that yet. But we do think that it's coming, and if that in fact is coming, and you look at the historical view of interest rates, they've typically fallen throughout the length of a recession. So what we're really talking about here is managing cash, our cash flow, for a specific period of time. So we have an arm. Then we have a recession and rates start to fall. At some point, it's likely that rates are going to fall in a strike window that's going to feel comfortable. It may be at the same or maybe a little bit higher for us to move to a fixed rate or a 30-year fixed mortgage, in which case we're only using this tool as a bridge to get us to our fixed rate product for a period of time. Do you see why I talk about it as a tool? Because in this case, it really is just a bridge. We're thinking about temporarily managing our cash flow to get this, the payment comfort zone in a realm where we can manage it to where we can get to the fixed rate window, if you will, right? Because circumstances are going to mitigate higher rates that we see today and bring them back down in line when the market rebalances itself. Now, we don't know exactly when that's going to be, so that's why we're taking this particular tool and helping us get there, okay? All of that being said, to review, there aren't any bad products. These are tools that you can use to effectively manage your assets and the cash flow on those assets. And that's what a house is. And that's effectively what a mortgage is. It's a tool for you to leverage, for you to purchase an asset and hold it. Now, in the case of an ARM, it requires a little bit more active management because you have to be aware of the time frame when that fixed rate expires. And when it expires, you have to have an exit strategy in place if you don't want to deal with the variable rate period, okay, which is after that fixed rate term expires. 321 and 2-1 buy downs are things that are coming back into the market and being popularized again today because interest rates are higher and foreseeably appreciation is going to continue to be strong in the market. So we need to make it more affordable for people to continue to purchase and find home ownership, the power of home ownership, and putting that money back in their pocket. I'm Bill Rodriguez with Cornerstone Home Lending, and this has been Bill the Lender Podcast, where we talk about all things financial services related and how they impact you and your real estate. Until next time, we'll talk to you soon. Take care. Thanks for listening to Bill the Lender podcast. Please reach out to me with any questions at 303-877-6323.